US recession fears have the markets spooked, but will central banks save the day? Welcome to Market Insight. I'm Elena Casas. Markets around the world are deep in the red this Monday. In Europe, the Stoxx 600 all but wiped out its gains for the year at the open after Japan's Nikkei chalked up its worst day since 1987. The sell-off started in the US after a weak jobs number on Friday, and traders are now hoping the Federal Reserve will ride to the rescue. They're betting on a 50 basis point rate cut in September. Well, to talk about the chances of that and more, I'm joined now by Chris Beauchamp, Chief Market Analyst at IG. Chris, why has this reaction to that US jobs number been so dramatic?
I think there's been a nagging fear that the Fed was keeping policy too tight over the last few months. Inflation was heading in the right direction, albeit in a choppy fashion. And you could start to see some signs of weakness in the housing market, even in employment. Look at the weekly claims figures. And I think July's number on Friday really just spooked everybody. It's probably a seasonal distortion more than anything else. I don't think it points towards a really sustained period of weakness in US job numbers, but there's been enough, I think, to get investors worried. If you look at things like the yield curve as well, that's been inverted for what's almost 2 years now, and it's heading back towards naught, or it was heading back towards naught, and uninverting, which is usually the more secure sign the recession is on the way. So the signs, the yellow warning signs, if you like, were stacking up, and Friday's jobs number and the fact that the Fed had held rates steady on the Wednesday of that week really, I think, tipped everyone over the edge.
Traders are clearly now hoping the Fed will save the day. Bond markets are now pricing in about 115 basis points of cuts between now and Christmas. Is that realistic?
Probably not. I get this eerie echo of what we had at the end of last year, when, of course, we were pricing in a very dovish Fed from the very beginning of the year, rate cuts in March and so on. Of course, that didn't happen. I suspect the market's getting overeager once again, really. The Fed essentially said last week, yes, we will cut in September, but it was crucially dependent on they'd need more inflation data to move in the right direction. Now that looks highly likely, so it really reinforces the view we do get a rate cut. But the Fed's job, of course, isn't to save stocks. It's not there to rescue the market just because we've had the first sort of real sell-off in the S&P for about a year or so, really, almost. It's there to do its job to protect the US economy. And I think the problem with people calling for aggressive rate cuts now, especially these emergency rate cut calls that we're seeing, that would probably worry more people and probably add fuel to the fire, really, to show, okay, there is something really wrong, rather than, as I still think is the case, we're just seeing a growth scare. Understandably, from Friday's numbers, but it's still that at the moment, growth scare.
What about the consequences here in Europe, where of course we're seeing sharply increased bets on cuts from both the ECB and the Bank of England? Might this force a rethink from policymakers?
Yes, I think so. The Fed has to move more dramatically, and that's the big thing. I think the ECB and the BOE would take their cue from them. Well, we will get a couple more months worth of inflation data before they meet again. So there is scope, I think, to give them the reasons to cut. And we know how weak Eurozone data, particularly German data, has been of late. And so that will, I think, reinforce the idea that the ECB needs to loosen policy as well. There's been a sense that if the Fed's behind the curve, the ECB is even further behind the curve and relying on data that isn't really sufficiently up to date with the actual situation. So yes, I think that will help markets. Although again, they have to tread a very tricky tightrope here, because if you sound too scared, that will spark more selling. It's important to remember we're in the midst of August and September. Liquidity is lighter. You often see weakness in stock markets during the summer months, even more so in election years. We haven't really had a sell-off all year. So even for European markets, this has sort of arrived at the kind of time you'd expect it to anyway. And I think it's been exacerbated firstly by what we saw last week, and of course, undeniably, by what we saw in Japan overnight.
Today's economic data that we have had from the Eurozone has been pretty weak. PMIs showed business activity at a standstill. We've been worried, of course, about Germany all year, but should investors be concerned about fundamentals across the Eurozone?
To an extent, yes. The case for worrying is certainly stronger in the Eurozone than it is in the US. There's a lot more, I think, wrong in the Eurozone economy than there is in the US economy. And it doesn't mean the ECB can do very much, of course, because they won't go back to any kind of QE program. but they might do a bit more of a more generous rate cut effort in the autumn. Beyond that, of course, I think the message needs to be, well, there's not much we can do really. Governments will have to step in really, and we'll have to hope maybe that things look a bit better by the time September, October roll around and things start to pick up again.
Finally, Chris, some analysts are already talking about buying the dip. Should investors be thinking that way? Is it too soon to say?
Well, if you were looking, if I'd said to you a month ago you could buy Nvidia when it was down 30, even more, 35%, then you probably would have grabbed that opportunity with both hands. Of course, every time a dip rolls around, everyone probably decides not to buy it immediately, you get worried. But the risk is that it continues to fall. These kind of events, especially what we saw in Japan, but also in the US and Europe, they don't stop in a single day. They take time to work out. You had very elevated equity exposure across the board. That will probably need to come down a bit more over the course of August and September. And I think with so much uncertainty ahead of what the Fed will do in September, the risk is that you jump in too early and you get knocked around by the volatility over the next 4 to 8 weeks, and then things start to come down and calm down, I think, and look a bit more positive. I do think we'll be higher from here year end. So yes, look at buying the dip, but you have to wait for the signs. At the moment, I think this market is still in a bit of a panicked liquidation mode, really.
Chris Beauchamp, Chief Market Analyst at IG, many thanks for that analysis. Well, that's your market insight. Don't forget, you can watch more videos on Reuters.com.